Welcome to the deep dive. We're here to sift through the noise, look at all the angles, and really pull out the key insights for you. Today, we're diving into a story that's, well, it's got that classic comeback appeal, but it's also fraught with risk. You know, the type thing, Carvana, companies hitting rock bottom and then boom, soaring back. It definitely gets investors thinking, doesn't it? Hunting for that next big turnaround, especially when the market's choppy. Our focus today, Wolfspeed. Maybe you remember them as Cree. They were big in LED lighting way back. Now they're all about cutting-edge semiconductor tech. But here's the twist, the big headline. Wolfspeed filed for Chapter 11 bankruptcy. So that's our mission for this deep dive. Unpack how they got here, figure out what Chapter 11 actually means for the company, for its shareholders right now, and the big question for you, is this distressed situation a massive opportunity or just, a trap? And we've got a lot to draw on. We're looking at analysis from A Motley Fool, Investopedia, Market Beat, market research from Grandview Research, some expert takes from the Investing Unscripted podcast, and even what people are saying on places like Reddit. We'll try to connect it all. Okay, so let's get into it. Wolfspeed. It wasn't always the semiconductor name we hear now. It actually started out quite differently.
That's right. It began as Cree back in 1993. And they really made their mark early on with innovative LED lighting. They were pioneers there.
But then they made some really decisive changes, didn't they? Big pivots.
Huge pivots. In 2019, they sold off their main lighting products division, that's now Cree Lighting, owned by Ideal Industries. Then, just 2 years later, 2021, they sold the LED chip business itself, Cree LED, to Smart Global Holdings.
So they were systematically shedding the old business.
Exactly, stripping it down to focus. And then came the rebrand in October 2021, Wolfspeed. The message was clear. They wanted to be a pure-play global semiconductor powerhouse.
And the name Wolfspeed, I remember reading it, was meant to convey speed and noble traits of the wolf. A bit dramatic, maybe.
Maybe a little, but it signaled serious intent. This wasn't just cosmetic. It was a fundamental bet on a completely different technology. Silicon carbide, or SiC.
SiC. Let's talk about that. Why is silicon carbide such a big deal? What makes it better than, regular silicon?
Well, it comes down to physics, really. SiC has superior properties. It's much more efficient, especially at high temperatures and high voltages. It lasts longer, and you can make devices smaller with it.
Smaller, faster, stronger, basically.
Pretty much, yeah. And that opens doors for all sorts of demanding applications. We're talking electric vehicles, battery storage, renewable energy systems like solar and wind, AI data centers, which are incredibly power-hungry, high-performance industrial gear.
Okay, so it's not just one niche thing.
Not at all. Think about EVs. CC helps enable faster charging, makes the powertrain lighter and more efficient, extends range. In defense, its toughness and heat resistance are great for things like advanced radar or even ballistic armor components.
Wow, armor.
Yeah, and even in healthcare. Because it's biocompatible, it's being explored for certain medical implants. It's really versatile stuff.
That's incredible. But hang on, if it's so great, why isn't it everywhere already? Are there downsides? Cost, maybe? Manufacturing.
That's exactly the crux of it. Excellent question. SiC is fantastic, but it's not easy or cheap to make. Manufacturing high-quality SiC wafers is way more complex than traditional silicon.
Okay.
Yeah, it requires super high temperatures, specialized equipment, and controlling defects is a massive challenge. So yields can be lower, and the cost per wafer is significantly higher. That's been the main barrier to mass adoption, though costs are coming down.
And competition. Are there other materials nipping at its heels?
There are. Gallium nitride, or GaN, is another important wide bandgap material. It competes with SiC in some areas, particularly lower power, high frequency applications. But for the real high power, high voltage stuff like EV drivetrains, SiC generally holds the advantage right now.
So SiC has this edge, especially for big power applications, but it's tough to make at scale.
Got it. And this market, despite the challenges, it's really taking off.
Right, absolutely. The demand curve is steep. Grandview Research pegged the global SiC market at, what, $5.23 billion this year, 2024?
$5.2 billion, okay. And they see it hitting $9.15 billion by 2030. That's a compound annual growth rate of nearly 9%. It's pretty healthy growth.
Nearly 9% CAGR. That sounds impressive. But let me play devil's advocate for a second. Are those projections universally accepted? Could something derail that growth? Maybe a slowdown in EVs or, I don't know, a breakthrough in a competing tech?
That's fair pushback. And yes, there are potential headwinds. The market is heavily tied to EV adoption and renewable energy rollouts. So if those sectors slow down significantly, CA demand will feel it.
Like the recent EV slowdown we've seen bits of.
Exactly. That definitely played a role in Wolfspeed's recent troubles. Geopolitics is another factor, supply chains, access to materials, trade tensions, especially involving China, which is a huge player in steel.
Right. China dominates production, doesn't
They
it?
hold a massive share, yeah. Over 59% of the market in 2024 was Asia Pacific, with China leading. So any disruption there ripples globally. And advancements in GaN could, theoretically, eat into some CM market share over time.
Okay, so risks exist, but the momentum seems strong overall.
It does. The core drivers, energy efficiency, electrification, are powerful trends. And look at the government support. You mentioned the $544 million DOE loan in the U.S. for siege production. The EU approved a massive $5.4 billion ST microelectronics seeds plant in Italy. That's serious backing.
Okay, so we have this amazing tech, CSIS with a booming, strategically important market, heavily backed by governments, and yet Wolfspeed, a leader in this space, files for Chapter 11. It seems counterintuitive. How did they get into such trouble?
It really boils down to ambition meeting reality, specifically the reality of cash flow and debt. They made enormous bets on building manufacturing capacity ahead of guaranteed demand.
Those huge factories you mentioned earlier, the billion-dollar one in New York, the $5 billion one planned for North Carolina.
Precisely. Over $6 billion in announced investments. That's a colossal amount of capital expenditure for a company their size. To put that $5 billion North Carolina plan in perspective, that's a staggering sum. Committing that kind of capital puts immense pressure on your finances, especially if revenue doesn't ramp up exactly as planned.
And they were counting on government money that didn't materialize fast enough.
That seems to be a key part of the story. They were banking on getting $750 million in the CHIPS Act, but there was uncertainty around the timing, particularly concerning the Trump administration's release of those funds. Relying on hoped-for subsidies adds a huge layer of risk.
So they're spending billions waiting for subsidies, and then the actual manufacturing. That wasn't smooth sailing either.
Apparently not.
Yeah.
Scaling up that 200-millimeter CP wafer production is, as we discussed, incredibly difficult. The sources point to rising costs. Factory startup costs doubled to $66 million in one period. That suggests they were hitting technical hurdles, lower than expected yields, delays, all very expensive problems.
And the numbers started looking bad.
They did. In the 9 months ending March 30th, 2025, revenue actually fell 8%, while the cost of that revenue jumped 24%. Margins got squeezed hard.
Ouch. Falling revenue, rising costs.
Yeah. And the net loss ballooned 36% to $940 million. Meanwhile, long-term debt climbed near $3.5 billion, and total long-term liabilities hit $6.7 billion by March 2025. It was becoming an unsustainable situation.
And the EV market slowdown hit them at the worst possible time.
Exactly. The perfect storm, really.
Yeah.
Massive spending, funding uncertainty, manufacturing challenges, rising losses, mounting debt, and then a key end market softens. That's the path that led to Chapter 11.
It paints a grim picture. So Chapter 11, people hear bankruptcy and often think it's the end. But Chapter 11 is different from liquidation, right? It's about reorganizing.
That's absolutely right. Chapter 11 isn't Chapter 7, which is typically liquidation, selling off assets, shutting down. Chapter 11 provides legal protection from creditors, while the company tries to reorganize its debts, its operations, basically create a plan to become viable again.
And Wolfspeed had a plan ready before they filed, a prepackaged bankruptcy.
Yes, and that's a critical detail. A prepackaged or pre-pack bankruptcy means they negotiated the key terms of the restructuring plan with major creditors before filing the Chapter 11 petition.
Why is that so important?
It dramatically speeds up the process. Instead of months or even years of fighting in court, a pre-pack often means the company can emerge from bankruptcy much faster, maybe just a few months, because the main disagreements are already resolved. It signals more consensus and less chaos.
Okay, faster and more controlled. But what about the stock? We saw the price collapsed. What happens to shareholders like you, the listener, if you owned Wolfspeed stock going into this?
Yeah, the impact is immediate and usually devastating for existing common shareholders. The stock price tanks. Wolfspeed was down 98% from its peak, trading around $1 a It gets delisted from major exchanges like the NYSE, often trading over-the-counter with a Q added to the ticker symbol, signifying bankruptcy.
And dividends?
Gone. Dividends stop immediately. But the most crucial thing for you to understand is the capital stack, the order of who gets paid in bankruptcy.
The pecking order.
Exactly. Secured creditors, like banks with collateral, get paid first. Then unsecured creditors, like bondholders, suppliers. Then preferred shareholders, if any. And dead last. common shareholders.
So common stock owners are at the very bottom of the list.
The very bottom. And in most Chapter 11 reorganizations, especially where debt is high like Wolfspeed's, there's simply not enough value left after paying off the creditors to give much, if anything, to the common shareholders.
And for Wolfspeed specifically, what does their plan say about current shareholders?
The plan is pretty explicit. Because it's a pre-pack driven by the lenders, current common shareholders are expected to receive only about 3% to 5% of the equity in the new reorganized company that emerges from bankruptcy.
Only 3 to 5%. Wow.
Yeah, it means existing shares are effectively being diluted into near worthlessness. Your old shares basically get canceled and replaced by a tiny fraction of new shares, if anything. It's a harsh outcome, but very typical when a company has this much debt relative to its assets.
That's brutal. So the idea of buying the stock now at $1.30, hoping for a rebound, it's incredibly risky because those shares are likely to be mostly wiped out by the restructuring itself.
Precisely. You're not buying a stake in a potentially healthier company that emerges. You're buying shares that are about to be massively diluted or canceled. The value, if any, will be in the new shares issued post-bankruptcy, which will primarily go to the former debt holders.
Okay, that's a critical distinction. So let's talk about that emergence. Wolfspeed has this pre-packaged plan, support from lenders.
Yeah.
What's the strategy for the new Wolfspeed?
Well, the core of the plan is the debt reduction.
Yeah.
They expect to slash total debt by about 70%, which is a massive $4.6 billion cut. That alone transforms the balance sheet.
$4.6 billion. That certainly frees up cash flow.
Immensely. They also expect annual cash interest payments to drop by 60%. So financially, they emerge much, much leaner. Operationally, they've stressed continuity. They're still shipping products, paying suppliers, operating normally. They had about $1.3 billion in cash going into this, providing liquidity.
And new leadership too, right?
Yes. A new CEO, Robert Furl, took over in March 2025, along with other new executives. The message from them is optimism, a stronger financial foundation, allowing them to finally leverage those big investments in their 200-millimeter manufacturing and accelerate towards profitability.
They expect to be out of bankruptcy pretty soon.
Their target is by the end of Q3 2025, so the end of this month, September. That's a very quick turnaround, typical of a successful pre-pack.
Okay, a swift process, much less debt, new management, same cutting-edge tech. Sounds promising on paper. But what about those underlying challenges? Does less debt automatically fix the difficulty of making sickle wafers efficiently?
That's the billion-dollar question, isn't it?
Yeah.
Now, restructuring the finances doesn't magically solve the operational physics and engineering challenges. They still need to execute on ramping up that 200-millimeter production efficiently, hitting yield targets, controlling costs.
Right.
And they're still dependent on the EV market and other 6-set applications continuing to grow robustly. The new management team has a cleaner balance sheet, but they still face immense pressure to deliver on the manufacturing and sales fronts in a very competitive landscape. Profitability isn't guaranteed just because the debt is lower.
So the execution risk remains high, even post-bankruptcy. How is the market, how are analysts reacting to all this? You mentioned caution and optimism.
It's definitely mixed. The overall Wall Street consensus right now is a hold. If you look at the 10 analysts covering it, it's split. 4 sells, 2 holds, 4 buys. Pretty divided.
A hold. And the price targets, you said they were forecasting a big upside, but the range was huge.
Exactly. The average 12-month target is around $9.80, which looks like a massive 650% gain from the current $1.30 price. And this is a huge but that average hides a massive range, from a low target of $3 to a high of $20.
$3 to $20. That tells you analysts are all over the map. Yeah. What does that extreme range signal to you?
It screams uncertainty and high risk. It shows that analysts themselves are struggling to value this thing during the bankruptcy transition. Some are clearly focusing on the potential of the new co with less debt in a growing market, the $20 bulls. Others are looking at the near-term chaos, the history of operational misses, and the massive dilution, the $3 bears.
So that average target isn't really reliable guidance right now.
I'd say it's highly speculative guidance at this point. It reflects potential if everything goes right post-emergence, but doesn't fully capture the immediate risks and the fact that current shares aren't the vehicle to capture that upside cleanly. Compared to peers in the tech sector, analysts generally rate Wolfspeed less favorably. Most tech companies get a moderate buy.
And the short sellers, are they still betting against it heavily?
Short interest is still very high, yeah.
Yeah.
Around 28% of the float was sold short as of late July. That's significant negative sentiment. However, there was a near 20% decrease in short interest compared to the previous month.
Oh, interesting. Shorts covering. What could that mean?
It could mean a few things. Maybe some shorts are taking profits ahead of the bankruptcy emergence, anticipating volatility. Maybe some are getting less bearish, thinking the restructuring will create a viable company. Or it could just be market noise. It's a slight positive signal, perhaps, but not definitive.
Okay, let's try to tie this all together for someone listening. We have the bankruptcy, the restructuring, the dilution, the operational challenges, the market potential, the mixed analyst views. The big question remains, is Wolfspeed a buy now, or do you wait?
Given everything we've discussed, buying the current Wolf stock ticker is extremely risky for most investors.
Because those shares are about to be diluted massively.
Exactly. You're effectively buying into the final moments of the old, debt-laden company, not the new, reorganized one. The value transfer in these situations overwhelmingly favors the creditors who are converting their debt into the new equity.
So that $1.30 price reflects the expectation of near total wipeout for current holders.
Pretty much. Now, could there be a speculative meme stock type bounce? Maybe. It happens. But it's pure gambling, disconnected from fundamentals. The advice from folks like Investing Unscripted, and it makes sense, is generally to wait.
Wait until when?
Wait until the company officially emerges from Chapter 11. Wait until the restructuring is complete, the debt is formally reduced, the new shares are issued, and the new Wolfspeed starts trading under, likely, a new ticker symbol, or at least without the Q.
So you let the dust settle completely.
Let the dust settle. See what the capital structure actually looks like. See how the market values the new entity. That's when you can start analyzing it as a regular investment opportunity, weighing the potential of its 6 tech and market position against the execution risks and valuation.
And the opportunity after restructuring could be real.
It could be, yes, if they emerge with that much cleaner balance sheet. And if the new management can execute on the manufacturing and capitalize on the psych market growth, then the new Wolfspeed could be an interesting prospect. It becomes a turnaround play, but one based on the new financial reality, not the old bankrupt one.
So patience seems like the prudent approach for most people here, avoiding the gamble on the pre-emergence shares.
For most investors, yes. The potential reward of catching the absolute bottom of the old shares is likely dwarfed by the risk of them going to zero or near zero upon restructuring.
Okay, so wrapping up our deep dive today, Wolfspeed's story is quite the roller coaster. From LED innovator to a pure play bet on silicon carbide, leading to massive investment, overwhelming debt, and now Chapter 11 restructuring. It really highlights that clash between incredible technological promise and the harsh realities of finance, manufacturing, scale-up, and market timing. So for you listening, it brings your own investment style into focus. Are you tempted by that high-risk, high-reward gamble on buying into the bankruptcy chaos itself, hoping for a lottery ticket win? Or does the more patient path make sense, waiting to see the new Wolfspeed emerge, analyzing its cleaned-up financials and future prospects once the restructuring is done? Wolfspeed's journey is more than just a company hitting hard times. It's a stark lesson, really, in how the capital structure works, who gets paid first, and that razor's edge between having great tech and actually making money from it consistently. So as Wolfspeed prepares to hopefully emerge from this, here's something to think about. In this fast-moving investment world, is waiting for the storm to pass simple patience? Or could it be missing a fleeting chance only the truly bold might seize?